ton of stuff happening in the market this week. About 170 companies already reported earnings. We called in some experts to break it all down for you. Steve Chiavarone, VP, Portfolio Manager at Federated Investors, thank you for being here. Michael Hans, Clarfeld Financial Advisors, Managing Director, Chief Investment Officer. We're going to break it all down. We're going to start with GDP. All right, Steve, I'm going to go to you first. 4.1, kind of a Goldilocks number, right?
Perfect number.
Not too hot, not too cold. What does it mean?
It's a perfect number because it was a strong headline number, which we all were looking forward to, but personal consumption was particularly strong, which means the consumer is doing well. Inflation surprised a little bit to the downside, which means that we're really not seeing a sign of pickup there. This is a Goldilocks number.
And does this therefore mean that the Fed basically can keep doing what it's doing, right? No reason to change course.
For the most part, but I think there's enough within this report that does seem to be temporary in nature, that isn't sustainable at really high levels to get them concerned. So they can look through items perhaps on trade, maybe some acceleration because of the fears of tariffs going into effect that brought this number up a little bit higher. But longer term, we likely can have higher trend growth than what we've seen for a few quarters, maybe one or two, but we will ultimately level back down closer to the high twos, low threes.
Yeah, that's the big question, right? 4.1% is not sustainable.
We don't need 4% to be sustainable. We need something closer to 3 to be sustainable, and we've been running at 3 now for 5 or 6 straight quarters on average. That's good enough. You get a little bit of a pickup that's seasonal, that's great, but what's important is underlying trend growth, which had been 2% or below, is now at least high 2s, low 3s. That's enough to get things moving.
Yeah, look, you can't rip this number apart.
No.
Let's talk about earnings season now. Overall, we're seeing a ton of beats, right? Amazon, Intel beat, Mickey D's beat, Starbucks came in line. What's your overall thought?
I think the overall thought, and we've seen this for a few quarters, is as simple as it sounds, don't miss. But
yeah,
the punishment for missing is significantly larger than historical. Right? So if you look at the upside surprises, you tend to see rewards of about 1% or so, and that's in line with historical averages. But to the downside, where you'd seen averages of around a 2.5% loss, it's pushing 4%.
Well,
so it's again not as much reward because of where we may be in the cycle and what the expectations are. So you really just don't want to miss, and that's really what we've been seeing.
And that's what brings us. You set us up here for Facebook. I mean, talk about a miss, right? Largest single-day loss in Facebook's history. Executives said they're going to probably miss in the future. How do you stand on that?
Yeah, I mean, I think, look, for Facebook and their shareholders, this is certainly a painful event. And it calls into question, why didn't management kind of guide folks better along the course of the last several months? However, what's important for us from a macro perspective is these are Facebook-specific issues in a lot of places, and they're not bleeding through to the rest of FANG. They're not bleeding through to the rest of tech. Those companies still look pretty good. Just ask Amazon this morning how they're doing. And so I think that there's still an opportunity for tech to do well and be amongst the leadership. For Facebook, tough day.
That actually is a great point, and I know our fearless leader, Jim Cramer, still believes in the tech sector as well. Twitter came out as well. How are you feeling about all that?
I think in general, to echo those points earlier, tech still needs to be a driver of this market if we're going to break out to new all-time highs and continue to see strong market performance, not just this year, but into the future. The growth rates are going to level off, and that's just natural in how these environments will ultimately transpire. But when you look at other sectors, this week it's interesting because tech has had some challenges and has rolled over, but financial stepped into gear. And even though they didn't react positively after earnings a week and a half, 2 weeks ago when the big banks reported, they've had a great week. And so leadership should broaden out, and that's going to be a lot healthier because the talk for the last few weeks has been there are only a handful of stocks dominating market performance. I argue with that a little bit because look at small cap, and the Russell is very different because that's doing incredibly well and that's broad-based. We can broaden out across sectors, see some consumer staples come back to life a little bit this week, see areas like financials really rally. I think that's important to just change the leadership a little bit, even if it's still driven by tech, but not exclusively.
Yeah, and I think actually that's a valid point and brings us to next week. What are you looking at next week?
Yeah, and I think it builds off of your point. You don't go into recession when cyclicals are leading the market. You don't go into recession when discretionary is outperforming staples and when financials are waking up and industrials are taking leadership. And so for all the bearishness that's been in place over the course of the last few months, the underlying internals of the market don't suggest that that's right. And I think what we're excited about are those value areas of the cyclical trade, the financials, the industrials. Energy is going to have 150% earnings growth this quarter, year over year.
Yeah, well, we just heard from BP.
Yeah, and I think that at some point, you're going to get paid for that. And I think we're very close to that time. We could have volatility over the rest of the summer. I think Q4 is going to be a really good time for the equity market.
And look at profit margins, right? It's also, even if we do see some deceleration in overall growth and we hit back to trend levels, profit margins have a lot of room to absorb some cushion on the downside. cushion related to rising interest rates, right? So I think earlier in the year, and I think our opinions are pretty similar, the market had a little bit of a hiccup, and I think 2 earnings seasons have really reinforced that even though there's a lot of talk and banter around recession, it just doesn't seem that it's on the near horizon.
And it almost seems like the tariff talk is backing off too.
Well, this week we had positives on Europe.
Right.
I don't know if that ultimately makes the situation any better or worse with China. I think, again, it's still dynamic and it's going to unfold,
Yeah,
and
no doubt.
you can't model it out, but again, you have to focus on what's actually been enacted versus what's been proposed, and then the potential to backtrack something where there was a considerable fear that it would be an escalation with the EU, and all of a
Right.
sudden, that's come back in a little bit.
Yeah, it was great news.
A sure money loser would have been to create a trading strategy around tariff headlines this year.
Right.
I think the key point...
Although that's hindsight. I think a lot of people tried to do that.
Well, we didn't do it.
It's a little, but it's a little Monday morning quarterbacking, right? Because people were saying, all right, this could be this could be awful.
It could be, but when you looked at what was threatened and what was implemented, at most, it got to 1/8 to 1/10 of the stimulus that's hitting the economy this year. $200 billion from tax cuts, $100 billion in spending stimulus, and $500 billion in cash coming back from overseas. Yeah, tariffs are bad, and there is an impact from that, but you've got to look at the magnitude, and it hasn't impacted confidence, it hasn't impacted earnings yet. It could,
Yeah.
but it also could not.
All right, since I am standing with 2 millennials, I have to ask, millennials are still making investing mistakes. I mean, we all are, but what are some of the big ones that millennials are making?
You know, I think, and it also depends on when you came into the industry or when you started investing. If you haven't seen a full market cycle, the belief that this time is different without, again, you can always witness history and study history, but there's a major difference between the two, right? So we were talking before about your experiences here during the financial crisis.
Yeah.
We were talking about TARP and the day that it failed. You live through that, you have a different perspective on what risk and reward looks like, as opposed to just participating in a market. If you just got in the last couple of years, your mindset is FANG, crypto, all the things that can really go well, never thinking about what the downside might look like.
And I remember, because I am a dinosaur, back in the day when they did things like, monkeys were throwing darts and winning. And that's kind of what this market was like if you just came into it.
I'm going to flip the question around on you just a little bit. I think there's more myths about millennials than there are the mistakes that they're making.
Fair enough.
So first is that they're overly indebted. They have less than average debt. They have higher student debt, but they don't use credit cards a whole lot, and they lived at home, so they don't have as much mortgage debt. But the return on real estate nationwide isn't very good when you compare it to your extra income from a graduate degree.
That's why they're renting.
And they save more, and when they hit 30, they go from investing a very small portion of their money in equities to a much larger portion, because that's when you start to form families and have children. So I think what we're going to see is the largest generation in our history is entering into kind of familyhood and markets in a big way, and they're going to have a voracious appetite for equities because they started later. If I take 2 investors, one's 20 and one's 30, they both want to retire at 60, and they've got the same amount of money today, the 30-year-old needs to earn a higher rate of return, and it's going to push them into risk assets.
That's a great point. So that's off to the races for the equity markets then.
I mean, it could be, and I've heard this from a bunch of different people and many strategists. They say you experience 3 major bear markets in your lifetime. The first one, to your point, you don't have enough assets to really participate in it. The third one, you're too late in the game and you're nearing retirement that you can't
and you're scared.
extend yourself in that risk. And it's really that second, that in that period of time you really see some good returns. But it all comes back to planning also. I think you have a more educated consumer in many regards, and they're more thoughtful about purchases. And again, we stress with our clients planning and investment. So there's again, the two go hand in hand.
Let's talk about the seniors though. Like you just mentioned that, if I'm older and I'm about to witness what could be a bear market, who knows? What am I doing? Am I getting out?
I don't think you get out, because I think you're always focused on where your allocation is, and I think the other concern now is, do I get out of my fixed income also, and do I just park my money in cash,
Right.
which again is the worst thing you can possibly do. So it's I think it's more mindful about what you don't own as opposed to what you do own. You don't want to extend yourself on duration, you don't want to extend yourself on credit, you want to be more balanced in your approach. And it's just doing the same things over and over again and not changing dramatically just because you're nearing retirement. Your allocation will dictate, you'll think about what your risks look like, but there's no major inflection point between the day before retirement and the day post if you've been doing the right planning and the work going into that.
Although there's been a lot of talk about this yield curve lately, and to your point about duration, we don't know where interest rates are going to go. We had a good GDP number today. Fed will probably continue to raise once, maybe 2 more times. Who knows?
Yeah, I think the yield curve is one of those concerns that we hear in every meeting that we go to, which means it's probably not what's going to bring us down. And what I mean by that is we've gone back and looked at it. If you look at how flat the yield curve is today, and you look at how long it then takes to invert, and then how long it takes to get to a recession, you're talking about somewhere between 30 and 44 months, and the market has been positive every single time that's happened at an average of nearly 100%. And so while the yield curve is absolutely a harbinger of recession a couple of years out, it has never been a sell sign for equities. We're at a very dangerous time for smart people. There will be signs of the end coming, but you need those signs to all build up before the end actually comes. It's going to take a while. We think that the risks are actually to the upside here because we think everyone has this genteel notion that we're going to have a recession in 2 years and they all know how it's going to work out and play out. That's not how recessions happen.
No, they're scary.
Yeah.
They're scary.
I think you have to build a mosaic exactly to what you said, where it's a horrible timing mechanism, just looking at the yield curve. Look at where credit spreads are today. They haven't started widening out. That tends to predate as well. So there's a lot that can happen, and I don't know that people should be positioning for the yield curve to continue to flatten dramatically. You never know what ultimately happens because you have numerous central banks that may come off of zero and put some various pressure at different points of the curve that could change the dynamic in the next 6, 12, 24 months.
It's a graveyard of folks that have tried to call rates the last few years.